Ali Vaddu, and today we are going to talk about key tax law changes in Pakistan implemented through Finance Act 2024. Earlier, a budget for 24-25 year was presented by the Finance Minister of Pakistan. And later on, after due debating, National Assembly has passed the bill into an act, and finally it has been implemented effective 1st of July 2024. So this act has brought lots of important changes which were due for quite some time. However, they have not been implemented earlier because of political and otherwise important reasons. But now probably Pakistan is at a stage where they were required to be implemented. One of the strongly debated change in this budget is about putting 10% surcharge on the tax payable by salaried and non-salaried persons. Generally, people have not taken it positively, and everybody I met during these days is complaining about it, because salaried class is already under lots of pressure. They have to pay for their school, hospital, and things have gone too much expensive recently. And on top of that, whatever tax they were paying, slabs have been changed, and now there is a 10% surcharge on it. So it's not being taken positively by the literate part of the society who are employees or otherwise consultants or service providers. Losses to companies are usually available for 6 years, and during which they can set it off against future profitability, and after that they get lapsed. In case of PIA, there has been an additional giveaway of 4 years. Now they will be able to utilize after the privatization, whenever it takes place, 10 years adjustment period. So keeping in view, PIA has been in losses for a long time. So if there is a light at the end of the tunnel after 10 years, it will be a welcome change. Another significant change, it's a restriction on sale, promotion, and advertisement expenses. Up to 25% of promotion advertisement can be disallowed if no proof is provided for their expenses. Generally, there has been a complaint that this kind of expenses are being utilized or being siphoned off to associated enterprises. So wherever it is happening now, the tax authorities can disallow up to 25% of the expenses claimed. There has been a clarification where spouses' assets and wealth statements included only if dependent on the primary taxpayer aims to, and this provision frankly aims to simplify the thing. In case wife is not separately liable to pay taxes or not filing any tax returns, so what she can do is her husband can in his own wealth statement can add his wife's assets as well. So the welcome clarification has been given. Period of limitation for tax appeals. Clarification on time limit for tax appeals has been provided. Previous time limit applies to pre-2024 Act orders, ensures fairness for taxpayers appealing tax orders issued before 2024. However, there is still some ambiguity, which probably will be clarified in due course. Now, mandatory ADRC for state-owned enterprises. State-owned enterprises, SOEs, must pursue cases in ADRC before the Appellate Tribunal tax demands are stayed upon committee formation. There will be an automatic stay provision applicable for CIRA appeals. requiring for ADIR cases. So in a way, this act provides that government-owned entities, state-owned enterprises need to pursue alternate route for dispute settlement for taxation before resorting to the legal kind of remedies. The major change has been implemented. This is about tax impact on exporters. Withholding tax rate remains at 1% for exporters. However, they have been brought into normal tax regime, which is a very significant change from the previous practice. So now exporters will have to come to the normal taxation. Nobody exactly knows how it will impact textiles. Maybe for some exporters it's a bad thing, but I can see number of exporters, textile owners may not have that strong an objective to this provision, because there have been no serious APTMA demonstrations or mills closing or something like that. So whenever it takes place, it appears that it's a beneficial provision for a large number of the APTMA and other textile councils members, and there are only few who are getting impacted. So relatively subdued agitation we have seen on this account. Small traders have been under kind of questioning whether they are paying taxes or not appropriately, and there has been generally a negative stance. There have been schemes like Tajir Dost. There is a minimum tax payment required. In case compliance is not done, the shop can be closed for 7 days, and on repeated offences it can be closed for 21 days. However, I think small traders, majority of small traders are barely earning for their living, and they may not be able to pay a huge amount of taxes. But there are large retailers or practically tier 2 category retailers who need to be brought into the tax net, and some serious actions should be taken instead of clamping on small traders, the ones which are seen in this picture. So it's a provision which has positive and negative both. This act provides a major shift on the penalty sides. FBR will be imposing 50 million rupees penalty for first tax offence and 100 million for repeated offence in certain cases. This is quite significant movement, and let's hope this can bring some welcome change to the mindset of non-taxpayers or tax evaders. The ones who are paying taxes already, they are being discriminated in the sense that non-tax paying have relatively much better environment to prosper in terms of their business, and in the similar business, similar kind of company, if they are paying full taxes, so their profitability gets hurt. So hopefully once everybody is brought to tax net, then everybody will prosper reasonably. Nobody will be prospering unreasonably, and nobody will be penalized unreasonably. Another important provision has been introduced. Tax fraud investigation wing will be conducting in-depth investigations. It will provide legal guidance and specialize in digital evidences. So hopefully better scouting will yield better results in terms of tax collecting and bringing a fair number of people under tax net, which has not been there for quite some time. Tax rates have been revised. There is no upside revision for salaried individuals, although there are some changes within their slabs. For non-salaried, it is now gone up to 45%, and for professional firms, it's gone up to 40%. So there has been significant change in the overall individual people's tax, and there is a 10% surcharge which we have discussed earlier today. So life of individual service providers is going, or business doers is going to be tough. There is another structural change in the taxation. A new class has been added, late filers. So there has been a non-filers category and a filers category. Now there is a third one, late filers category. In the previous regime, there has been, in a way, incentive being non-filer because you pay a little bit tax, 10-15% at the time of investments, at the time of purchasing new vehicles or other assets. And by and large, you evade 30-35% taxation, which would have been applicable on that kind of earnings if full tax was paid. Now it appears that they are being brought at a level of taxpayers wherever they try to invest or purchase goods and services, they will be required to pay a higher withholding tax or taxation. So maybe this can bring a very welcome change, and including late filers provision will also help in getting more people to the tax side. There has been a significant mismatch, people investing elsewhere or investing through mutual funds or REITs. The taxation was different. Now there are efforts to bring them closer to each other. So certain provisions have been introduced where higher tax will be applicable to investors who make gains or otherwise income from mutual funds and REIT gains. So this is a change which is counterintuitive in the sense that it will not help with saving more money, where Pakistan has already very low saving rate. However, on the other hand, instead of putting money in these funds, people may be investing their money elsewhere, and hopefully some economic activity can be generated instead of putting money in the funds. During last couple of years, there has been a movement of tightening the grip on tax exempt and all kind of amnesty given real estate sector. Now real estate has been asked to pay capital gain on whatever they make. So it's a 15% flat rate on capital gains after the promulgation of this act. So on the previous ones, there may be a different approach, but going forward, it looks like now government has decided for one reason or the other to bring this real estate sector into tax net. There has been lots of wastage of money around every city and town and even villages. There are miles and miles of developed plots. No construction is being done. People are simply developing plots, selling, investing, getting capital gain, but in reality, there is not much economic activity being generated, and basically fertile agriculture land is being brought under these plots, which are not even being constructed houses, and it's not even bringing the rental per month down. So it's a welcome change. So there is advanced tax on motor vehicles. Percentage-based tax system has been introduced. Tiered tax rates based on vehicle value brackets aims to simplify calculations and promote transparency. So this is an area where every day new cars being launched. Their CBU and CKD imports at subsidized rates actually are partly responsible for whatever foreign exchange problems Pakistan has. Maybe telecom was another area where all kind of PTS and mobile phone systems were implemented in multiple form, although one tower would have been sufficient for a number of telecom companies, but everybody installed their own separately. So huge amount of money was wasted on that, and then on handsets, fancy handsets imported free of tax. Now all this is being brought to taxation, including vehicles, are being progressively taxed, so it's a welcome change. As I mentioned earlier, there is the enhanced advance tax for late filers, imposes higher tax on property for individuals on ATL who didn't file returns for the last 3 years. A balanced approach with rates higher than ATL taxpayers and lower than non-ATL for fairness has been implemented. So this is a good move. Certain changes have been introduced to the appeals and pecuniary jurisdiction. Appellate Tribunal for complex cases with large amounts, specific monetary thresholds for the jurisdiction of appellate commissioners has been implemented. This will encourage amicable settlements and requires detailed written arguments. So it's kind of a cosmetic change. Important clarification, the period of limitation for assessment. 6-year limitation from the end of the assessment year or return filing. No further orders on the same information for enhanced certainty and streamlining of the administration of this entire process. I think this is a good change. There were certain unaddressed tax matters, like lack of guidance for non-first schedule tax rates in 10th schedule. Late filer limitations are only applicable to property transactions. Specific guidance missing for withholding tax calculation and capital gain exceptions. This may require some further clarification. So there has been a change in advanced tax mechanism on sales to distributors, dealers, wholesalers, and retailers. Previous scope limited to sales by manufacturers only. Now the scope has been extended to include sales to intermediaries. Implementation aimed at improving tax collection and transparency in the supply chain. This will improve tax collection for sure. First schedule rates of tax. It's a new table 3 has been introduced for items not in table 1 and 2. Revised FED rates for air travel and property transfers. Introduction of FED on sugar supply. So air travel has become much more expensive, much more expensive for club class and business class, first class flyers. However, for economy people who are already unable to pay high ticket costs now will have to pay a much bigger as compared to their pocket 12,500 FED. So this is apparently this is a tax on kind of rich, but there are lots of people who travel abroad for their living, worker class or junior labor, junior employees class. So an additional tax has been implemented on them, although they are the key source of bringing much required foreign exchange at home. The third schedule is about conditional exemptions. It outlines conditions for tax exemptions on imports by diplomats, missions, and privileged organizations. Certifications required for exemptions typically issued by the Ministry of Foreign Affairs. Exemptions for goods imported by UN agencies, diplomats, and embassies, and Gulf dignitaries. This has been clarified to please or appease certain dignitaries and foreign missions. Another significant change is about the tax for mutual funds and REITs, elimination of the preferential rate of 10% on capital gains from mutual funds and REIT schemes, impact on investments. This will obviously will not encourage investment on this side unless return on these items is also improved. So it's a mixed kind of reaction on this. So commissioners, whether they are tax commissioners, deputy commissioners, or commissioners, they play a very important role in Pakistan's governance. Every now and then their powers are taken away only to realize that they have been the backbone of the regulation, whether in the society or the tax system. And now their authorities and powers have been restored to a significant extent. Let's hope this will bring some positive change and will not be a source of problems for the genuine taxpayers. So there has been a generic and significant change in tax system in Pakistan this year. It's about abolishment of final tax regime, whether it's about exports, mutual funds, or many other where preferential or fixed tax regime was implemented. In majority of the cases, it has been removed. And now every business has been brought to similar kind of taxation, which is a welcome move. There have been major changes about tax on exporters, and there are significant changes related to tax on importers. So this entire side has been overhauled, as we have seen in a couple of slides earlier about exports, and now some import related things are given on this slide. In certain cases where tax was not due or was not applicable or lower tax was applicable, commissioners were authorized to issue reduced rate tax certificates. However, now their criteria has been modified, and large import transactions will be a focus area where reduced rate certificates can actually cause loss of revenue to the exchequer. There are some other changes introduced in the tax system. So these may have significant impact on how the sales tax and withholding tax and custom duties are collected. Here is a bit more about the restrictions on commissioner powers for reduced rate certificate issuance. New criteria for issuing reduced rate certificates has been provided, and this will limit to promote fairness. The powers now will be used more fairly, hopefully so. There has been a practice, especially for smaller businesses, that people, once they come in the limelight of taxation, they will close that company or that business and start in a new name somewhere else, in some other name, in some other office, in some other way. Now business discontinuation has been spotted as one of the revenue leakage. So some penalties have been imposed, which will amount to a certain percentage of tax evaded, or 25,000 or 1 year imprisonment will be there. So rather harsh kind of announcements. Let's see how it can improve tax collection. Small trader have been the focus of this act. So penalty for small traders for avoiding monitoring, reporting, they can receive imprisonment or additional fines if they are concealing or they are not compliant. So even imprisonment can extend up to 2 years, and penalty can be up to 500,000 or 200% of tax evaded. That is the kind of punitive measures introduced to make small traders compliant for tax. This act has done some good thing about bringing all the transactions to banking channel system. without notebandi or something, real action of that sort, like it happened in India, but at least lukewarm kind of measures have been taken over here. So there will be a fine per transaction per supplier in a tax period where it is not complied with. Otherwise, there can be denial for tax benefit for buyers. So some measures have been obviously introduced, which is quite interesting. The government has realized that there have been some avoidance of tax payment on shares. So strict penalties for failure to pay tax on share transactions have been announced. 150% penalty on unpaid tax and up to 3 years imprisonment provisions have been introduced. So the leakage, especially where physical certificates were there, this leakage now is on the radar of FBR and government of Pakistan. Penalties have been introduced for tax non-compliance in securities market, introduction of penalties for companies and AOPs for failing to pay tax on share transfers. Penalty is 150% of unpaid tax for both the entity and responsible individuals. Reflects the government's efforts to ensure fair tax compliance across entities. Aims to encourage companies and AOPs to prioritize tax obligations. The high rate of interest in recent years has brought many taxpayers to default on payments because it was cheaper to borrow from taxman as compared to from bank. So now the rate has been revised to 18% per annum, which is 1.5% per month. So hopefully now interest rate on bank borrowings is also expected to come down. So there will be little play available to avoid or delay payment of taxman. Pakistan is good and has been sufficient in implementing new institutions. So a tax fraud investigation wing has been established. This wing will be within FBR to combat tax evasion, conduct in-depth probes into complex fraud cases, will take legal action against tax evaders to promote compliance and enhance tax collection. These are all fancy, interesting things. Let's hope how far this wing goes. There has been some revision with respect to appointment and jurisdiction for appellate tribunals, changes to the appeal process, with the federal government now appointing appellate tribunal members for 3 years term. New criteria for members, advocates with 15 years in custom law, custom services officers with BS 21 plus or BS 20 officers with 3+ years in grade expanded pecuniary jurisdiction of the appellate tribunal to address a wider range of custom-related disputes. So this is an improvement in a way in the custom taxation service. There has been some changes in the appeals and alternate ADRC appeal filing process. Now it will be within a 30-day time frame, and there will be new fees. If you want justice, you should need to pay up. Maximum 90-day stay and 90-day appeals within a 60-day extension option for appeal time frame. There has been some now legislation to speed up the process. Let's hope tribunals will speed up the process. There are some changes in the appeal hearing procedures. Fixed hearing dates and adjournments only with rupees 50,000 cost. So if your lawyer is unavailable, you or your lawyer need to, or your authorized representative has to pay up 50,000 rupees to get the date adjourned. So this is a good provision. ADR is allowed even with FIR if no criminal proceedings are initiated. Reduced appeal withdrawal period from 60 to 30 days. Now, if satisfied with the committee's decision, quick reference applications related things have also been changed. and fee has been increased from rupees 100 to 50,000. Wow, this is one of the biggest increase I have seen in terms of fees. Now this is a taxation in itself. In any case, there will be a grace period of 15 days after tribunal order, during which collector cannot recover duty, but after that, whosoever has been penalized will have to pay up or go to next forum and get a stay order. Vehicles and properties. These are special focus areas for this year's budget and taxation measures. So there have been a number of discussions during this session from various angles on all this. There are tax rates varying based on property, location, size, and the market value. There will be a lower and higher tax rate for each kind of transaction. So there have been changes on the purchase of vehicle, taxation, registration related modification in the procedure. Then there are transfer related taxes, and rates have been also revised. So there is a plethora of changes on the vehicle purchase, registration, transfer environment. As I have mentioned earlier, there will be advanced tax on immovable property mandated on property transactions exceeding a certain value, with rates varying based on property location, size, and market value. So threshold has been now provided. There are some further clarifications required, but by and large, this topic has seen lots of attention from the regulators. So there have been significant changes in the FED, especially related to air travel. Economy class has been increased to 150% in terms of FED, and in terms of business class and first class, increase is even phenomenal. So there are some changes on regulatory duty exemptions and capital value tax. RD has been removed on certain imports, and adjustment to CVT rates has been promulgated. Farmhouses 2,000 square yards to 4,000 square yards now will pay annually ₹500,000 to own this farmhouse, and for twice this size, $1 million, and for residential houses up to 2,000 square yards, starting from 1,000 square yards, there will be ₹1 million per annum CBT, and residential houses exceeding 2,000 square yards will have $1.5 million capital value tax.